Assalamu alaikum and hello everyone. In today's lecture, we will learn how to calculate operating cash flows from direct method as well as indirect method. In the last lecture, we have discussed how to calculate operating cash flows from direct method, and you can see that in this way we calculate actually, or we list down all the actual cash transactions, that is cash received from customers, cash paid to employees, or paid for inventories, interest, taxes, and so on. The direct methods shows the specific cash inflows and outflows that are related to the core business operations. These information are generally not provided in the problem, and we will have to do it in separate workings or shows supporting calculation to calculate all these amounts. We are using Financial and Managerial Accounting by William Zaka Bettner, or Meigs and Meigs. And in this lecture, we will cover problem 13.4 and 13.5 to cover the direct as well as indirect method. So you can see that we have income statement is given, and then selected accounts balances are given. You can see there are some current assets and current liabilities, and here we have the beginning balance and a year-end balance is given. So with the help of beginning and year-end balance, we can find out the increase or decrease in the current assets and liabilities. That will be useful for the calculation of several cash flows for operating activities under direct method. And furthermore, you can see that dividend revenue is recognized on cash basis. Further additional information is given, and the next one is operating expenses include depreciation expense of $115,000. So this means that these operating expenses that were deducted from the income statement included that depreciation expense. So while preparing cash flows, we are going to adjust it in the net income. And then in instruction, partial statement of cash flow is required because only operating activities section is required. So we are going to prepare operating activities using direct method in this problem. And for negative amounts or cash outflows, the amount should be presented with brackets, and show supporting calculations or computation for the following means: cash received from customers, interest and dividends, cash paid, interest expense paid, or income tax paid. So the first computation or first supporting calculation is cash received from customers. So working one is cash received from customers, and we have net sales. Obviously, first of all, we get cash from net sales. So net sales, which is 250,000. Now we adjust any increase or decrease in accounts receivable. So you can see that accounts receivable from previously it was $720,000, and at the end of the year it is 650. So you can say that there is a decrease in accounts receivable. So whenever there's a decrease in accounts receivable, which means that customers have paid off some of their outstanding balances. So this represents additional cash flows during the period. Therefore, in order to calculate cash received from customers, we are going to add the decrease in accounts receivable. So there's a decrease in accounts receivable. We are going to add it. Decrease in accounts receivables. And how much the decrease is actually, uh, here we can calculate any decrease or increase. You can see that here we have 720 minus 650, so 70,000. So here we have 70,000 decrease in accounts receivable. Then in next, as we have no other entry related to this, so you can say that by adding these two, here we can get any cash. This is, so this is your cash received from the customers. This is the first requirement, cash receipts from customers. So the next working is interest and dividends received. So working two, interest and dividends received. So the total dividend income here, it is 104, and additional information is given. The dividends revenue is recognized on cash basis, and all other income statement amount are recognized on accrual basis. So only dividend is recognized on a cash basis. So this means that this dividend income, which is 104, so this dividend is basically cash based. We are going to mention it dividends income, as it is cash basis, so there is no adjustment is required on this dividend income. So here this is dollar 104,000. The second is interest income. So as in interest income is on the accrual basis, then there must be any increase or decrease in accrued interest receivable. So we will check it. First we add interest income. So interest income is 70,000. So as it is on accrual basis, so we are going to adjust any increase or decrease in accrued interest receivable, and you can see that from 6,000 to 9,000 means there is a 3,000 increase in accrued interest receivable. So as a you can see that a portion of interest income has not been collected, which is 3,000. So this means that this 3,000 has not been collected. In order to calculate the actual interest income, we are going to deduct it. So this is increase in, so we are going to deduct it, increase in accrued interest, because this has not been collected. That's why we are going to deduct it, which is minus 3,000. So by adding all of these, we get $171,000. So this is your interest and dividend received during the year. So these are your the next working is The third one, cash paid to the suppliers and employees. So this is one of the very, you can say, a difficult one, because it has so many elements in it, means salaries or operating expenses and depreciation and so on. So many adjustments are required for cash paid to suppliers and employees. So much attention is required in this portion. So working 3 is cash paid to suppliers and employees. And we started from cash paid to the supplier. This is first calculation. So cash paid from the supplier. The starting point is the cost of goods sold. So if we take cost of goods sold here, which is $150,000. Then in cost of goods sold, first we will adjust any increase or decrease in the inventories. So we can see that inventories, which is initially it was 765, then at the end of the year it is 800, which means that there is a increase of $35,000 in the inventories. So this indicates that you can say company has purchased more inventory than it sold during the period. This reflects additional cash flows from the inventory purchases, and in order to calculate the actual cash paid to the inventory, we add any increase in the inventory to the cost of goods sold. So now we are going to add increase in inventories. So 35,000 is increase in 35,000. So 35,000. Then another accounts payable is also related to the calculation of amount with the suppliers. So we can see if there is any increase and decrease in accounts payable. Um, you can see that merchandise supplier, previously it was $562,000 currently, or at the end of the period, so you can see 570,000. So you can see that there is a increase of $8,000 in the accounts payable to the supplier. So when there's increase in accounts payable to the supplier, which means that the company has purchased inventory on credit but has not yet paid for it. So, in order to calculate the actual cash paid for inventory, we deduct or subtract any increase in accounts payable from the cost of goods sold as a portion of purchases that was actually not paid. So, what we are going to do in the next adjustment is to deduct any increase in accounts payable to suppliers, or accounts payable that is related to suppliers. So how much is increase from 562 to 570, which means that $8,000 is increased now. So we have $8,000 here. And as um, we are going to deduct it less, so this should be presented with the bracket sign. Here you can see. The next is when we add or subtract all these things, we get cash paid to the suppliers. So net cash to pay to the suppliers are 100 cash paid to the suppliers are $1.577 million. So here it is the cash paid to the suppliers. And next we are going to adjust any cash paid to the operating expenses. So cash paid to the operating expenses. So the total operating expenses are here you can see that $980,000. So operating expenses are say $980,000. So first of all, we will deduct on any non-cash expenditures like depreciation or amortization. So you can see that in additional information, we have $115,000 of depreciation. So we are going to deduct it less depreciation expense because depreciation expense is a um, non-cash expenditure. So minus 115,000 is your depreciation expense, and we can see if there is any increase or decrease in the prepayments here. Short-term prepayments are there, and there is a increase in short-term prepayment. So we are going to add any increase in short-term prepayments or prepaids. So how much? 5,000. There's increase of $5,000. So we are going to add it, and again we have what we have remaining. We have accrued operating expenses are there. So you can see that because these are related to operating expense, so we are going to adjust it here in the calculation of operating expenses. From 95,000 to 65,000 means that there is a decrease in accrued operating expenses, or you can say there is a decrease in liability of how much 94 minus 65, which is $29,000. So if there's a decrease in accrued operating expenses payable, which means that the company had paid a portion of previously you can say previously accrued expenses payable. So in order to calculate actual cash paid, we add any decrease in it. So as there's a decrease or decline in it, so we are going to add it. Add increase in accrued operating expenses payable. So we have how much the increase is. Basically we have decrease. We are going to add any decrease. So the next one is this one is remaining because this is accrued operating expenses payable. This is the liability, and you can see there's a decrease from 95,000 to 65,000. This means that the company had paid a portion of previously accrued expenses. How much the company has paid from 95 to 65? This means that 29,000 the company has paid this portion. So in order to calculate the actual cash paid, we are going to add this decrease of accrued operating expenses payable. So we are going to add any decrease in accrued operating expenses payable. So 29,000 is the net decrease. So uh, add 29,000. So next is to calculate the total of any increase or decrease from operating expenses. Here you can say cash paid for operating expenses, and when we add both of these we get total. Mhm. So class, when we add both of these, the outer column, that is cash paid to suppliers and cash paid for operating expense, we get total cash paid to suppliers and employees. So cash paid to suppliers and employees, and the total amount is 1,577,000 plus we have $899,000. So this represents the total, which is which we are going to present with the dollar sign. So this is our third working. The fourth one is interest paid. So the fourth working is required. Working four is interest paid. So the interest, total interest expense you can see here is 185,000. So we start from interest expense, which is dollar 185,000, and as it is mentioned here, all items of all other income statement amounts are on the accrual basis. Then this means that we will have to adjust any increase or decrease in the interest payable. So here we have the account accrued interest payable, and you can see that there is a increase in interest payable from 12,000 to 21,000. So how much there's a change from 12,000 to 21,000 means that 9,000 change is there. So what we are going to do, this you can see this increase. So this increase means that a portion of interest expense has been recorded but not paid in cash. So that's why in order to calculate actual paid for actual cash for interest, we subtract any increase in interest payable. So here we have, as we have the increase, so we are going to deduct it. Increase in accrued interest payable, which is total 9,000. So minus $9,000. So the actual cash involved in the interest expense is total interest paid, is by adding these two we get total interest paid, which is $176,000. So this is the amount of interest paid, and the next working which is required, last one is income taxes paid. So working 5 So the income tax which is given is total 90,000. So income tax is total dollar 90,000, and we are going to deduct any increase or decrease in accrued income tax payable. So you can see there's a decrease in accrued income tax payable. So if there's a decrease in accrued income tax payable, which means that the company has paid off some of its previous previous tax liabilities. So in order to calculate actual cash paid for taxes, we add the decrease in income tax payable. So as there's a decrease and the decrease, and we are going to add any decrease in accrued income tax payable. So decrease in accrued. So when you take the difference between 35,000 and 22,000, you get 13,000. So 13,000. Here you are going to add these amounts. So the total is 103, which is total income tax paid. So these are the workings that were required in the requirement, and then prepare a partial cash flows indicating operating activities under direct method. So we are going to so we are shifting these calculations. So we are preparing partial cash flow statement. The name of the company is Freeze Incorporation. Then cash flow statement, which is partial, and this is for the year ended December 31st, 2011. And here we have cash flows from operating activities, and this method is the direct method. So the starting point is cash flows from, we present all cash receipts first. So the first cash receipts is from customers. So we have cash receipts from customers, which we have calculated in working one. Go to this one. So we are going to copy it. 29 and $20,000, which is dollar 29 and 20,000. The next is interest and dividends received. Interest and dividends received, which we have calculated in working two. The amount of interest and dividend received is, you can see that $171,000. Here we have calculated it. So 171. So these are the total cash received from operating um, activities. So you can say cash inflows from operating activities. So the total are, and we represent it in the outer column. You can see here. Then we have cash paid, in which we have interest paid in requirement number Okay. Then we have cash paid to the suppliers and employees, and which we have calculated in working 3. So we can check how much cash paid to the suppliers and employees, the total um, here, this one, 2476. So we have in the inner column $247,600. Then again we have interest paid and income tax paid. So income tax paid was working 5, and interest paid was working 4. So you can see that mm, 176 was interest paid and 106 was income tax paid. So 176 and 103. So we have dollar 176 and 176 and dollar 103. As all are the cash outflows, you can cash outflows from operating activities are, you are going to add it, and the total is to class the total outflow of the cash from operating activities are 2755. So this represent cash outflows from operating activities, which we are going to present in the outer column with minus sign because these are cash outflows. This is 2755000. So the net increase or decrease during the year from operating cash flows are 336. So here we have net cash provided by operating activities are this one. So this is our answer from the direct method. Here we have another requirement remaining. Here B part, management of the company is exploring ways to increase cash flows from operation. One way that the cash flow could be increased is through more aggressive collection of accounts receivable, obviously, assuming that the management has already taken all the steps possible to increase revenue and reduce expenses. Describe any two other ways that cash flows from operation could be increased. So you can say just in time inventory concept. So the first one is that the company can reduce the amount of inventory being held. So if the company reduce the inventories, then in this way the company improve the cash flows from operating activities. The another one is the reducing the amount of short term prepayments of expenses. So company also reduce or stop paying short term prepayments for expenses. And Another way could be that the company can take great advantage of accounts payable as a short-term means of financing for purchases, and goods means the company can increase purchasing goods or services on credit. So in this way company can also increase cash flows from operations. So here we have the same problem, but the method is different. The method is cash flows from indirect, activities. So we are doing it on the same page as we have this one. Copy it, and here instead of direct method, what we are going to do, indirect method. Okay, and the starting point is net profit or net income. So net income, you can see here we have net income. The net income is total $223,000. So we add all those activities that are going to increase any cash flows. So add. Now, you can see depreciation expense. So as depreciation expense is a non-cash expenditure, we are going to add it back in the net income. So depreciation expense, and it was $115,000. You can see this one, $115,000. So depreciation expense $115,000. So then we have if we have any increase and decrease in working capital, now we can check it. For this, remember one thing: if there is a increase in current assets, this means that the cash flow will be decreased, and vice versa. And if there's a increase in current liability, then cash will also be increased. So in other words, you can say that while preparing cash flows from operating activities under indirect method, um, all the current assets has inverse association with cash flows, and all the current liabilities have direct association with the cash flows. So here you can see, we can check one by one. There is a decrease in accounts receivable. So as current assets have inverse association, this means that decrease in accounts receivable will increase in cash flows will be. So decrease in accounts receivable, how much? From 722 um, 650, which means that a 70,000 decrease. So here we have um, dollar 70,000. Then accrued interest receivable, this is also again you can say accrued interest receivable is current assets, and you can see that from 6,000 to 9,000 means there's an increase in accrued interest. 3,000 increase in accrued interest received. So if there's an increase in current assets, this means that cash will be decreased. So we are going to deduct it, increase in accrued interest receivable, which is 3,000. So we are presenting it here, 3,000. The next one is inventory. So inventory is also current asset, and there's an increase in inventory from 765 to 800, which means that 35,000 is increased. So as per rule, increase in inventories or any current assets will decrease cash flows from operating activities. So this is $35,000. Then the next one is short-term prepayments, and 5,000 if prepayments are increased. So these are current assets. So increase in short-term prepayments, which are $5,000. So here, dollar 5,000. The next one is these are liabilities. All last four, or one, two, three, four, all last four amounts are accounts are liabilities. So accounts payable and all the increase or decrease in current liabilities shows direct association with cash flows. So you can see that there's an increase in accounts payable. So if there's an increase in accounts payable, this means that the cash will also be increased. So increase in accounts payable for supplier or suppliers. How much increase from 562 to 7 means 8,000 increase. Then we have accrued operating expenses from 94,000 to 65,000 means decrease in accounts payable. So cash will also be decreased. Decrease in operating expenses payable. So decrease in operating expenses payable. And how much decrease from 95,000 to 65? This means that 29,000 decrease. So 29,000. The next one is accrued interest payable from 12,000 to 21,000 means there's an increase in accrued interest payable. Increase in accrued interest payable. Increase in current liability means the cash will also be increased by, here we have 9,000 difference from 12,000 to 21,000. Then last one is accrued income tax payable, and you can see there's a decrease in accrued income tax payable. So cash will also be decreased. Decrease in accrued income taxes payable, and the amount is 35 minus 35 minus 22,000, we get $13,000. 13,000. And you can also see that there is a gain. Here you can see gain on sale of marketable securities. So this is a non-operating gain. So we are going to deduct it, any non-operating gain, or add any non-operating loss, because this is operating activity. So this shouldn't be the part of operating activity. This shouldn't be included in net income. So we are going to deduct any non-operating gain, which is gain on sales of equity securities, which is how much the gain is. The gain is 4,000. So we are going to deduct it, $4,000. Here we have $4,000. So the total increase are 202. So total increase, and the total decrease are, when we add all of these, so here we have total decrease in cash flows. So we are going to represent it with minus sign or in bracket as per the requirement. So the total increase or decrease would be, here we have 223,000 plus 202,000 and minus 89,000. So here this one is our total increase or decrease of cash from operating activities. So we have cash provided by operating activities under which method? This one is indirect method, and you can check the cash provided by operating activities whether we are using direct method or indirect method. Both are same. However, the way of calculating these amount are different, entirely two different approaches, but the answer is same. Here you can see that this one. So this one is the more direct approach toward net income. We add all the accounts in the net income. We adjust all the account in net income. Whereas in direct method, you can see we calculated directly the cash receipts on payments from various ways. So that's it from this lecture. Take care, class.